everyone, welcome to The Global View, the show where we look at ways for investors to make money beyond the ASX-listed universe. I'm your host, Juliet Sarli. Just having a quick check-in on a thought from Platform X, and this comes from Gunjan Banerjee, a Wall Street Journal correspondent. She posted about the move that we've seen in 10-year Treasury yields, noting that they've completely retraced highs from this fall back below 4.2% and the lowest yield since August. And of course, we saw that coming through after that data we had overnight showing the economy is starting to cool. So let's get you caught up on some of that economic news, with US job openings falling to a more than 2.5-year low in October, the strongest sign yet that higher interest rates are dampening demand for workers. That boosted market expectations the Fed's tightening cycle is over. The job openings and labour turnover survey, or JOLTS, also showed there were 1.34 vacancies for every unemployed person in October, the lowest since August 2021. Meanwhile, the US services sector picked up in November amid an increase in business activity. The ISM non-manufacturing PMI rose to a reading of 52.7 in November from 51.8, which was a 5-month low. New orders remained flat and a gauge of input inflation dipped as the lagged effects of higher interest rates start to have a greater impact. And as we mentioned, US Treasury yields did fall, the benchmark 10-year touching its lowest level in several months. For more on all the macro data, I'm joined now by Jay Hatfield from Horizon Investments to discuss more on his outlook for the global economy. So Jay, good to see you. Just to get your thoughts on that JOLTS data and these encouraging signs we're continuing to get that the economy is cooling.
Thanks, Julia. It's great to be on. Well, we actually think the data today is consistent with most of the data coming out of the labor market recently, which is a healthy cooling and normalization of the U.S. labor market. It's not, we don't, in our opinion, not really driven by so much monetary policy as much as just pandemic normalization. You know that we had this, what we call the overstimulation bill, where we paid people a gigantic amount of money to not work, right, as we were coming out of the pandemic. And, we had this shift where people became used to being at home. So that's kind of gradually unwinding. And that's we actually don't think that's a key driver of inflation, but it doesn't matter what we think because the Fed does. So it's clear that the Fed's on hold. We do think that Fed rate declines implied by the futures market is probably a little overdone, but the rest of the world may be faster than people think, that's implied in the markets. Like even in Australia, there's one cut implied by Europe futures market, but the Eurozone's in a major recession right now, 2.4% decline. So we are bullish about rates next year, not because of the Fed as much as the Eurozone and other central banks. And that makes us bullish on the stock market. We have a 5,100 target on the S&P, which would be a good year, relative to the levels we're at right now.
All right, we'll come back to some of those calls in terms of momentum for 2024, but just on the broader inflation picture as we start to see those levels cooling somewhat, I was interested in what you were saying about the bleed through of energy prices too and how that's affecting the overall basket.
Well, thanks for asking about that, because we think this is part of the issue with our fundamentally flawed Fed, is that so they focus too much on the labor market, not enough on money supply and housing, but more importantly, not enough on energy, because what they don't seem to appreciate is that energy prices don't just affect headline, they also affect core. So 5% in the US, 5% of business costs are energy, but some, like airlines, are 40%, a lot of foods are 40% energy. And so we really think the Fed should target headline CPI and not core. And we also think they made a gigantic policy mistake, Volcker did, in the 70s by tightening policy when all the inflation was really driven by the 1,200% increase in oil prices. So the Fed continues to make the same mistake, but it's very bullish because we've had a plummet really globally, but in the US, about 20% on wholesale gasoline prices. That's going to feed into the next 2 months of CPI. So we're bulled up about a cool print for November and December, and for December and January.
So all of that, of course, reflected in the bond market too, and we saw the 10-year Treasury yield dip back below 4.2%. I note you're bullish on bonds in 2024. That flows through into the broader macro picture as well, and touching on what we're seeing in the Eurozone that you mentioned before. Just give us your thoughts on where the bond market moves next year.
Well, it is what we think was missed in the US is that we have a global bond market, and makes sense because sovereign bonds are very fungible. They essentially have de minimis, at least with the countries that have obligations in their own currency, really have no default risk. So there's some currency risk, but you can hedge that. So they're pretty fungible. So we all move together. So we think that everyone in the US became too bearish because they thought it was all about the US budget deficit, but it was really ultra hawkish policy coming out of the ECB. They had to reduce the global money supply by 700 billion, which is gigantic, in a week to hit their rate increase target. So we're going to have the exact opposite next year, where we have almost every global central bank cutting rates, which means the money supply goes up globally. We have that on our website. It's the only place I've ever seen it, the global monetary base. And that's typically super bullish for equities and bonds. So that's the heart of our bull case. It's not so much a slowdown in the US. We think we're resilient here for a whole bunch of reasons. But the Europe really has no bull case, and is their current GDP now, you can Google it, that's published by an independent source, is currently tracking negative 2.4, which is a major recession.
And Germany, certainly the weak link there. When you talk about the overall US economy, though, you say remaining resilient. So it is likely it will continue to avoid a recession in your view?
Yeah, so we have some very unique dynamics in the US. First of all, we're one of the few true capitalist countries. Maybe Australia is also included in that. You can make your own judgment. But not just that, we have the lowest natural gas prices in the world. This isn't just the US, but Canada as well. So North America is about 80% cost advantage on both natural gas and electricity. We benefit most from the AI boom. We have infrastructure spending. That's probably the first time ever in the history of the United States we had good counter-cyclical government spending. So focused on investment, not consumption, because investment is what drives recessions. And then finally, we have a shortage of homes in the United States based on some dynamics from the financial crisis, and also relative to the baby boom in the United States. So that's what normally triggers recession: crash in the housing market, crash in employment and manufacturing that feeds the housing market. And we have none of that, and no evidence of that occurring anytime soon.
So what does all that mean then, Jay, for where we see markets go in 2024? You mentioned you're bullish. Just talk us through your target prices and I guess where investors should be looking for growth.
Yeah, so we do have data to support our targets, it's worth noting that we have been extremely accurate. So our target this year, established at the beginning of the year, was 4,500. So we're very close, and we were very bearish the prior year. But so we have real data, so you can come to your own conclusion. Based on treasuries rallying, so not necessarily here, but rallying some well below 4%, a fair multiple on the S&P would be 19 times. And so our targets, the year-end target, so it's based on 25 earnings. Right now, that's $270 for the S&P. So that gets us to a 5,100 target, which now is closer to consensus, certainly, than our 4,500 target last year. I've heard a lot of 5,000 targets, but we're a little bit more bullish. And also, we'd say risk to the upside. So AI probably creates a risk to the upside that we have some sort of tech boom and blowout on the upside.
And so is that the sectors we should be looking at? I know you say large cap dividend stocks as well.
Well, yes. So the only thing that's a little bit of a nuance to that, we'd like preferred stocks and large cap dividend stocks, which are two of the funds, which we manage in two of our funds. But there's just a proviso that you have to risk adjust it. So in other words, like even our core fund outperformed the NASDAQ on a risk adjusted basis. It's going to be hard. If the market's way up, the NASDAQ's the riskiest, is going to be up the most. But for unit of risk, we do think it's extremely attractive to buy these sectors that have been hammered by this, we think, irrational move up in rates. And so that does include what you mentioned, large cap dividend stocks like we hold in ICAP. And then preferred stocks are always good to buy when you're coming out of a cycle because they trade below par. So you get equity-like returns and fixed income-like income.
And Jay, just a final question more geared towards, I guess, this part of the world and the resilience that we're seeing in China's economy, how that affects commodity prices, what you're seeing in oil.
Yeah, so we're a couple of points. One, we are more bullish about China than most, at least maybe you don't have this in Australia, but in the United States, everybody kind of assumes that China's going into this major recession. When you really look at the data, they're growing 5% this year, forecasted to grow 5% next year. And that's critical because they're the number one importer of oil. So we forecast a small increase in oil consumption. They mostly incrementally consume coal, but and also continue restraint from OPEC. So our target has been a great target this year, $85. We're increasing that a little bit next year. And we do think the current weakness is not a fundamental supply and demand imbalance, but we have had, you're of course in the summer, but we're in the winter and we've had a warm winter in North America, which is also true in Europe. And so we think that most of the weakness below our target, the $85 target, is driven by seasonal factors and not a fundamental supply and demand imbalance on the negative imbalance.
Jay, thanks so much for your insights and for joining us here on ausbiz. Jay Hatfield there from Horizon Investments. Just before we go as well, we are looking, of course, at what the market is expected to do today, and the future's suggesting we will get a gain of around 0.4% following the mixed mood on Wall Street. But of course, as we look to those moves in commodity prices as well, we've got Rio and Endeavour holding investor meetings as well. But that does it for this edition of The Global View. Stick around, the Open is coming up next.